Usually you share the code at the start.
Yeah.
Okay. You can share the code.
I did the same thing. Yeah.
See if there is. The remote controller there is not. That's fine. We can do in this way. Okay, I think we can start. Take a seat, please. This is the code. So if you want already to check in, you can. This is the code for today. I don't know, usually I start the class by asking, there is also my colleague, any questions from last week? Any questions? No? What is security regulator?
Is the conglomerate of norms that tries to set the base for when companies have to make their shares public in very simple terms.
So for example, if I am a company and I want to get listed on the market, you say there is a group of norms or provisions that have been scored depending on the jurisdiction, because it depends on the stock exchange. For example, the provisions of a stock exchange are the same of the lawmaker.
They usually are related because the regulator, if you have soft law, and then maybe it's made hard law, but when regulators have those types of norms, stock exchanges usually have to comply with them, but they may also have, let's say, best practices that may be inappropriate in the market.
Anyone else? The provisions of the stock exchange, like listing requirements of the stock exchange, can we say that are the same of the lawmaker that maybe is making the passing the law in relation to companies that they get listed on the market? You are the expert.
I couldn't hear the question, sorry.
Yes, essentially, I mean, we said that there is a stock exchange. First of all, I don't know what is the stock exchange.
It's a market on which companies are publicly listed so that outside investors can
Yeah,
buy
market,
securities.
I mean, these are two concepts. There is the stock exchange and then there is the market. So we can say that those two things, I mean, are different. But usually list shares on the market is governed and regulated by a stock exchange. But of course, sometimes can be a regulated market, sometimes can be also a non regulated market or less regulated market, over the counter market. So markets, I mean, there are different typologies of markets. If we look at Europe, we have even more typologies because are regulated by specific directives and including also, for example, the possibility, I don't know, anyone has ever heard about AIM market, alternative investment market. Have you heard about that? AIM, yes.
Corporate finance.
Exactly, corporate finance, yes. How many of you took corporate finance? Okay, not many. So what we are looking today essentially will be to be covering what we did in corporate finance, but with some tweak, because later on there will be another colleague of ours that is from HSBC. He's a legal counsel, and he will come here to introduce you to IPO, initial public offering. That is the process when a company for the first time is going to get listed on the market and to offer securities on the market. So that is something that we will see later on. So today we just put some basis, and these fundamentals then will serve you in order to know better how to follow this method. We will go maybe in more details, also examining the UK listing requirements that were updated very recently last year, and other results coming this year. So essentially in this way you have a full picture, even with an example that is a real example. So coming to us, we said this course is about securities. So securities regulation is the regulation of securities. What is a security?
It's a bundle of rights that can be sold, exchanged.
It's a bundle of rights, so it is based on a contract.
Yeah.
And why it is based on a contract? What is actually an example of a security?
A bond.
A bond, exactly. Securities can be a debt, like bond, notes, for example, promissory notes, or can be also, especially the one that we know, everyone of us know, it is equity. So equity usually is shares. So shares can be ordinary shares. So this is for corporate finance students. We had a look, I mean, there are different typologies of shares. Ordinary shares, then other preference shares, then dual class shares, for example. So I mean, all these different typologies are giving to you different rights. And that is something that is right. Once you said a bundle of rights, because it depends on the rights that are written in the contract. Once I become a shareholder, I can be ordinary shareholder, preference shareholder. And then there are different rationales why a company is issuing this, why you are buying one or the other, why, for example, a founder of a company prefers to be the owner of dual class shares and not ordinary shares. Those rationales, I mean, you study more in corporate finance. So here is a course that is already something that you should know what is a security, but we look at the rules that they govern those securities that are traded on the market. Financial markets then is very, I mean, broad terms, and is something that we will speak many times about this because we need to deal with securities. But it's something that sometimes you find out more in international finance. I think before there was Professor Walker, and I think some of you, you're already here, you should know more about capital markets and financial markets from that course. The notion that we introduced today are notions that, as we said, are fundamentals that then you will use within this course. Because, for example, my colleague, he will introduce to you all concepts that they are related to another typology of finance. The one that is in front of you is the finance that you know, and is the one that we always used since 2000 years ago. And actually, if you want to know more about this typology of finance and also the other typology of finance, that is decentralized finance and centralized finance, this is something that you can also see from my monograph. I wrote a book that is The Speculator of Financial Markets, and that is where you can find all these distinctions, but especially how in financial history we arrived to those distinctions. In traditional finance is a concept that, as I told you, is very old. and in fact relates to ancient Rome. Even in ancient Rome, there was a market, because we were speaking about markets. They were not the equivalent of modern financial markets, but if you still go in Rome, there is a place in the city. I am from Rome, and in this place that is the Forum. In this place actually was a real market, like the London Borough Market, where they were selling products, agricultural products, and in that market there were also some people that they were trading shares, or the equivalent of shares. And those people, they were in some writings of the time defined as the speculators. Those that they were taking advantage and making profit by buying low and selling high. So this kind of behavior, attitude of the market, where there are people that they want to take in some way advantage of market participants, has always existed since immemorial time, since the time of ancient Rome. Then things, they evolved in time, but still, always in Rome, there was what we can define as a concentration of capital. So at the time of Rome, for example, you needed to go for long voyages, and you needed to, in reality, finance those voyages. So all this concentration of capital was a concentration of risk. And once there is a concentration of risk, you need to distribute risk. A form to insure, in reality, and be hedged against risk is insurance. And insurance was the equivalent speculative instrument of hedge funds today. It's something that, both in Rome, there were not hedge funds, but actually the behavior, the aptitude to take risk and to try to profit from the risk that you take, something that you saw in corporate finance, because in corporate finance we spoke about higher the risk, higher the profit. And that is something that was always there in financial history since ancient times. Today, this concentration of capital, if we need to think about this, is in financial intermediaries. Even in this course, we will speak about financial intermediaries. So, financial intermediaries, in modern terms, are who is a financial intermediary?
Oh, an agent.
The bank. For example, we can do in this way. So basically, when I was in Paris and I was attending a course by a professor in Cornell University in New York. Actually, they designed this diagram, and they said this diagram, although very simple, can be the equivalent of financial markets. So we spoke about markets, and that is what financial markets in reality they do. They match different interests. There is always someone that would like to have money because they don't possess the resources, and others that they have more resources than what they do. And so they are willing to lend. For example, in financial intermediation, you said about a bank. The bank actually, is the one that is lending you money because you need money and you have an idea that you need to finance because, for example, you are a businessman. So if you already see from this diagram, the risk taker is on this side, on the side of the businessman, of the borrower, while the one that wants to be risk averse is on the side of the lender, that doesn't want to take excessive risk because, well, for example, if you go to your grandmother and you ask money because you don't have money, you are just a child, or you are just a teenager, and you ask grandma, can you give me money? Because I have a beautiful idea, I can set up a company of orange juice. What your grandmother will say? Yes. Because she loves you.
Because she can also mitigate the risk because the amount of money that she has is significantly higher than the amount of money she's willing to give me. So even if I wasn't offered to pay her back or the lender can mitigate the risk because it
But
just
I think
has
your grandmother, she loves you and she will not ask the interest or the money back. So really, I mean, they say that the best bank in the world is mom and dad because you can always take it but never to back. So that is basically something that can relate to us, but is different in financial markets because actually a bank is not your mother, or father, or grandmother, and they care about having back those money. In our system, that is the system of Western finance, so the finance that is in reality here, UK, Europe, US, we believe in interest. So we believe that this money back, the capital, the initial capital that is given, and then you give back, is not sufficient. You always need interest. But it is not true in all the world. I mean, in a system of Islamic finance, if they follow Islamic finance in a pure way, the interest is the prohibition is prohibited. So there is no interest in Islamic finance. There is only capital that is passing by. And this capital is passing by because that is a model of real asset finance. So something different because they don't take risk on something that is in the future and they don't believe that money generates money. Our system is different because there is the interest. So the interest, what can represent in this diagram? If, for example, there is risk-taking here on the borrowing side, the lender risk averse, why we charge interest? Because what we want to do with the interest? What is the function of having an interest rate? Yeah. Is the cost, and in fact is the measure of risk. If the borrower, for example, is not very reliable and the solvability of the borrower is not very high, at some point the interest rate should reflect this risk that I'm going to take. And so the interest rate to you will be much higher than to a businessman or billionaire because the level of assets behind and the level of credit usually is much higher than you. And it is also why the level of money that you can get is higher than you. But the level of interest rate is even lower than you. You are riskier investment for them. Now, this model didn't work all the time. So sometimes there were also times in history where they lent money and then the interest in reality didn't reflect the risk that they were going to take when this happened in history.
Well, in 2006.
Yeah, 2008, 2007, yes. The global financial crisis. So reality in subprime mortgages, that is the condition that happened. Well, in reality, if you are a subprime mortgagee, you are not at prime rate, so you are below prime rate. But this was not reflected in a good way, and then of course we know all the things about derivatives, but this is not something that we speak here. It's something that you will find out with me and Douglas in our course on derivatives. There we will speak about global financial crisis more in depth and what happened with credit default swaps, CDOs. So examples that are still actual in order to understand the work of derivatives. But derivatives were also in ancient Rome, for example. I mean, it's not something new. Actually, everything that you see in finance, everything that you start to see about even securities that they were traded, so shares of companies, were still also in ancient Rome. What is changing is the type of regulation, because regulation in reality can change on the base of historical events that they happen in history, and then the regulator is reactive to that event. After the global financial crisis, there were more regulatory reforms on central counterparties, on many other aspects, but before this law was not there. So we might say, some people, they say that the regulator is always in delay, it's not acting beforehand. Something is happening and then something is going to change. For example, next week I introduce you the Financial Conduct Authority, and so the regulator of financial markets in the UK, and then we will see that before the Financial Conduct Authority and the Twin Peaks model between the Financial Conduct Authority and the Prudential Regulation Authority that sits within the Bank of England, there was the Financial Services Authority, and that was pre-global financial crisis, but then Northern Rock that was the moment where they decided to change the system and to have another model of regulatory architecture. So regulation, securities regulation, and regulation in general, is changing on the base of different kind of historical events that they can happen, and the regulator is going, lawmaker also, is going to react to those events. The same we will see even in this course once we go in more specialized lectures about special purpose companies. Before there was not the boom and bust. After the boom and bust, the Securities and Exchange Commission, that is the regulator of the US, of financial markets, they started to enact a SPAC reform, but before not. Before there were only listing requirements. For this, I wanted to say essentially that there are many rules actually that we need to look at. Some rules are from the stock exchange itself, and those are listing requirements. Those rules sometimes can be hard law, and so you must comply with that. Other times, and so are also enforceable. Other times, it is just soft law. So soft law, in reality, is not enforceable. It's just an advice, a suggestion that is given to the issuer. But then, of course, usually the exchange, if you don't follow, it's very difficult that it's going to list you. So the type of soft law that you find in financial regulation, usually we say that it's even harder than hard law, because actually the people are more willing to comply with that in order to get the results that they want, and to comply and to be more virtuous, and to be able then to offer the securities on the market. But usually once there is a soft law rule, there is always a case-by-case examination of the exchange. So the exchange will verify your situation, and even if maybe you comply with the advice, still they might decide not to list you, because they might perceive that there is something negative in relation to the protection of investors. So one of the main concerns of those securities regulation that we will see once we touch upon US securities regulation is the protection of investors. That is key in securities regulation. At the time of Anteroma, there was not this kind of protection of investors. There was not an equivalent in modern terms. This is something that we needed a lot of financial crisis or bad events, economic crisis, in order then to achieve what we have today. But what we see in traditional finance is that traditional finance is the finance that we know since time immemorial. So it's the type of finance that is based on this kind of idea of the lender and the borrower, on giving money and using markets to match different interests, rather than doing the barter and going to something that is more regulated, and I find what I need. The equivalent of today, in fact, if you think about financial intermediation, are intermediaries that are going to match the interests of the different parties. And for example, if I have a lot of money, I might put this money on investment account, saving account in Barclays. Barclays is a commercial bank, but the saving account of Barclays maybe is giving 1.40%. And it's not a lot, for example, on the money that you deposit there in the savings account. If you have more money, you can use a mutual fund. So the mutual fund is a pool of money, of investors' money, are managed by a specific person that is the manager of the investment fund, and they are going to invest your money in different kind of financial instruments. This kind of financial instruments depends on you, or you can delegate to the manager, but are always based on the same concept, risk. If you want to risk more, you might profit more, but you might lose all your investment. If you are in the intermediate, you will find out another investment that is more tailored for you. So the market then evolved and gave to market participants a lot of different options. If you like and love risk, you go to hedge funds. So hedge funds are the extreme on the other opposite, where in reality they perform and they pursue alpha strategies. But not everyone can invest in a hedge fund. So usually you must be a wealthy investor, someone that has at least 5 million under management. You cannot with 100,000 try to start something with an hedge fund. But hedge funds, in reality, they perform different strategies, and among these strategies, I mean, there is also the fact that they might, for example, perform financial arbitrage. What is financial arbitrage?
When there's maybe certain gaps in regulation that may incline a certain financial institution, or in this context, a financial institution, to avoid or go under the radar of certain regulation, for example, to keep in under certain limits of capital to avoid being considered as X type of entity. It's like, so in conclusion, it's like a type of technique used by participants in the market to
Yes, hedge
avoid
fund. Usually hedge fund they perform financial arbitrage. But I mean there is a difference in the sense that there is a regulatory arbitrage and then there is financial arbitrage. So really things a little bit different. For example, regulatory arbitrage, if you think about stock, there are different rules in different parts of the world, in different exchanges. Some of them they might be more competitive, others they might be less competitive. So if for example I am the sponsor, I put all the money to set up the stock, and then maybe the list the stock exchange where if you find a target I cannot vote on my same money, I put the money but I don't have the right to vote on the business combination, this is not very competitive. Rather than listing in London or listing in York where this kind of condition does not apply. So the regulatory arbitrage is not a problem. It's something that in reality exists because markets are interconnected, markets are operational cross-border, and because there are different rules in different parts of the world, I might have a choice to list or to set up my company in a jurisdiction that is more convenient, advantages for me. But this is still within legality. It's not illegal, essentially. Apart from, there are also states that they tell you if you want to set up a company, I don't know, and offer shares in a country, you must have a Malaysian company entity. There you cannot have a Cayman entity that is listed maybe in Malaysia. So if there are some specific rules, you need to follow the rules in that jurisdiction. But if there are not obligations or limits, everything is possible. Because everything is based on the knowledge of the party and the sophistication of financial parties. For this, if you are a lawyer, and you are advised by a lawyer that knows comparative law, usually it's very good because you can have different options rather than having someone that only knows English law, for example. So that is regulatory arbitrage. Financial arbitrage is more a technique of finance performed by hedge fund, where in reality they might take advantage of different market conditions. They might buy, this is something that I think you can also say that is about Bitcoin. The decentralized finance, financial arbitrage, if you think about hedge funds that they invest in decentralized finance, the conditions of selling and buying in different parts of the world are different. You might buy in one country, they sell in another, under conditions that are more advantageous. And that kind of transaction sometimes takes not days, like in a matter of hours. And that is why financial arbitrage is different to be performed, because you need to be constantly looking at the charter. But if you are able to perform those things, you can make an increase of profit that is quite consistent for your investors and for yourself. So this is just something, an introduction, because in this course we will touch upon financial intermediation. And so you will have also the fact that this middle fund, hedge fund, collective investments, as you want to call it, in every country of the world, they must fulfill different kind of requirements in terms of authorization, for example. So there are different rules, even related to financial intermediation. Then, coming back to us in financial history, because then later on there is a man speaking about IPO. The IPO, we said, is the initial public offering. So this is a company usually that is going to issue for the first time shares on the market, and those shares on the market issued for the first time, they give rise to primary market. Then, once the shares are listed on the market, in the primary market, you, as an investor, you can sell investor to investor, because they are trading. So the traded shares can be traded, and this is a secondary market. Investor to investor. Issuer to market is the primary market. Okay? Any question? So in financial history, the main example is the VOC. The VOC was created in Amsterdam, and actually was in the Dutch Republic, the period of the Dutch Republic, so the 17th century. And this is something that relates to a case where we had a company, joint stock company, for the first time. They wanted in reality to oversee the commerce of spices in Asia, because Asia was not known by the time, and the routes, commercial routes, also they were not known. So it was quite a risky venture. This risky venture were financed by a joint stock company. The joint stock company then had a duration quite limited in time, and they needed as every company to pay dividends in reality at some point, if there were dividends. These dividends, I mean, at the time were not very huge, and so there was a problem of liquidity. So, as always, in a problem of liquidity, there is not enough cash, and there are not enough assets to turn back into cash in a quick time to pay shareholders. So some shareholders they were paid in cash, others they were not paid in cash, and they decided to be paid in spices. So the one that in reality they had an idea, they started to think, because I'm a shareholder and I have a share certificate, I can sell the share certificate to someone else and I can get cash. And so this idea that seems really very simple gave rise to the Amsterdam Stock Exchange, that is the first stock exchange in the world historically. And this is how in reality they were trading in a market, and it is always the point, they were trading in a market. Something that they were selling bread. And so this kind of idea of financial markets derive from this informality that then they became formality, because I mean all these markets then they started to have a physical building, and in this physical building they were carrying out the trading of shares, the London Stock Exchange, New York Stock Exchange. Even in New York, at the time of New York, I don't know, this trading was performed in the street, or even here. Before the London Stock Exchange as a physical building, formal stock exchange, the trading of shares was performed, if you go in bank, the station of bank, in the square that you see, that was where they performed the trading of shares at the time. And then they moved to coffee houses in reality during the Puritan age. And in coffee houses they were trading shares, and then the coffee house is one of the most famous, Jonathan's Coffee House in London, became the London Stock Exchange. In fact, if you enter, it's not possible to enter very easily, but if you enter the London Stock Exchange, they still have a bar, a coffee house, essentially, that is written Jonathan's Coffee House, in memory of the time, how it worked, essentially. All clear? So this is quite important in traditional finance. So we believe that those are the four main pillars of traditional finance, where there is the role of financing. So this kind of role of lending money to small, medium enterprise. So the fact that the commercial bank, the main role is to lend. They take deposits. Deposits are money. These deposits that are from you are used 90% to finance something, to have loans on the balance sheet that are reported as assets. So this is one of the main functions of commercial banks and how the economy is running through commercial banks. The deposits, they have a problem that essentially, here, even in this country, if I deposit money in a bank, there is a famous case law, legal debate in English law, that is telling you that those are no more your money, but are the money of the bank to do whatever it pleases. So, legally, in reality, you are giving away one of your most precious assets, but in return, you will have, if it is in a saving account, some kind of interest, or in return, you will have the safety that essentially, at least in a real world, your money are safe in the bank rather than keeping under the mattress that someone can steal. So that was the idea. But then, as we know, banks can fail, and so this kind of failure of banks, and this is coming back to 1929 in the crash of Wall Street in the US. That is where deposit insurance started to take place, because to give again confidence to market participants and to investors and to depositors to put money in the bank, President Roosevelt approved the New Deal, and there were laws related to banking law that they instituted the Federal Deposit Insurance Corporation that was giving reality insurance for depositors. This deposit insurance in reality is not, unlimited. There is a cap. How much is the cap?
Depends by the
Yes,
jurisdiction.
it depends on the jurisdiction.
In the European Union,
100,000
100,000.
euros.
In the US, 120, 125.
I think 250.
250.
250.
So here in the UK,
In the UK it was 85,000. Now there was a reform, they increased a bit. But generally, yes, they tend to be closer. The US is giving much more, a bit more. So it means if I am a depositor, I can deposit money in the bank. This is giving confidence. In fact, even in this diagram of the market, when I was speaking about the grandmother has confidence into you because you are the nephew. But then in reality, maybe you can set up a business that is going to fail. But even the bank has to have confidence. Even the borrower has to have confidence in itself to start a business. And so this kind of confidence, and especially the secret word is trust. In fact, if you see also the dollars is written in God we trust. So that is to show that trust is key. So without trust, this economic system will not run. Without trust in the banking system, without thinking that with the insurance that is given, you will not deposit money in the bank because you think it's too risky. So to give further trust into the system, there was also added a function to the central bank. So central bank, one of the main functions, is that they perform the lender of last resort. And so this kind of lender of last resort facility that is injecting liquidity into the system and into the possible entity that is going to fail is giving more trust to depositors and then to businesses that they also receive money from the bank and then the economy is running. But the lender of last resort is discretionary, so it's not something that you will give to anyone. The main point is that the lender of last resort, this slide is quite important, is something that today is given to the traditional actors of traditional finance, so the banks and then other types of financial intermediaries, if they are quite huge as investment firms. But still is discretionary, it depends on the concession of the central bank, and it's not given for free, it's not for free. So in reality you have to have good collateral and it's given at penalty rate. So it's not for free in any case. That's why, because if you are a financial intermediary, you should have also responsibility. So if you are not responsible, there is not a free lunch. You need to earn those money and those trust from the central bank in any case. And to run the system even better, this concept of prudential supervision that is going to be performed in our case. For example, next week I will speak about the Prudential Regulation Authority that is sitting within the central bank, the Bank of England, and is performing this prudential supervision that then can be micro or macro. So macro for the whole entire system in terms of avoiding systemic risk, and micro, that is the supervision of the single entity. Both, they do this, the Financial Conduct Authority, the Prudential Regulation Authority. The Prudential Regulation Authority with more emphasis to banks. But still, the Financial Conduct Authority is issuing, for example, some types of business rules of conduct for bankers. So this kind of jointly supervision is there to assure that rules are coordinated, are harmonized, and they are supervised by entities that is not one single entity like the Financial Services Authority, but both entities are into play. So those pillars represent the pillars of traditional finance. If you are an actor within traditional finance, you have also a right to access the lender of last resort. Maybe they don't give you, but you have the right to ask. You have, if you are a commercial bank, deposit insurance, and also this kind of insurance exists for financial intermediaries, but is performed by other agencies of the government. And then there is this prudential supervision. There are specific rules that are designed to supervise those traditional actors, the actors that we know. These kind of actors that we know, then in reality, I mean, the line between traditional finance and some other forms of finance were blurred by this concept of shadow banking. And here there is the famous phrase of the IMF, the International Monetary Fund, that is telling you this kind of proverb: if it looks like a duck, quacks like a duck, and ducks like a duck, then it is a duck, or so the thing goes. However, what about an institution that looks like a bank and acts as a bank? Often it's not a bank, it is a shadow bank. So, in reality, are actors that they cannot be defined as a bank, and so they are not under the regulations that they apply to banks. But then in practice, they perform the same kind of transactions that the bank would do. For example, real example is the one of Celsius. Celsius was a crypto bank in New York. This crypto bank in reality was performing the same function of a bank, of a commercial bank, in the sense here in the case of a bank, commercial bank, traditional actor, there were depositors that you put money. In the other case, there were token holders that they were putting tokens in deposit. Why they were putting tokens in deposit? Or also for you, if you are traditional, why you put money in the bank? Just to see if you understood the function, essentially. For example, if I am Celsius and you have tokens and I want your tokens because then I want to invest in other things. So I want to do the same thing that the commercial bank is doing because I want to take money and invest the money in something else. What I should promise you to allow your interest to increase your interest. What I should promise you.
To give the money or the token back.
This always. In the sense that, I mean, this is something that you have a right of force demand that you can withdraw. Then depends on the account that you open. There are also in traditional finance account that you cannot withdraw as you want, are longer maybe than a year. You cannot touch the money. But you will be compensated by interest, exactly. So basically it's the same thing here. Celsius was promising those token holders higher returns. So if you deposit your token with me today, in 1 year you will have plus 7% on what you deposit. Now, to keep this promise, in reality, you must invest in something that is even riskier, because otherwise you cannot keep the promise. And this is what Celsius, in a brief line, did. Those investments then underperformed, because at the time there was also the scandal of FTX, that was a decentralized exchange. In that case, so there was a sort of spreading of systemic risk in decentralized finance, and Celsius Bank failed. So it was a crypto bank, but then failed as every other bank in traditional terms. What was the main problem there? If Celsius is not a bank but acts as a bank. If we look back at this kind of slide, if I am a token holder, did I have insurance? Yes or no?
No.
No, exactly. If I was Celsius, so the main provider, the possible bank that I'm not a bank but I act as a bank, can I ask the lender of last resort to the Federal Reserve? No. And that is the main problem, in the sense that I am another form of finance. I can still act and mimic traditional finance, but if there are not specific rules designed, I cannot go in this direction. So I cannot have this lender of last resort performed by a public authority like a central bank. There are also private forms of lender of last resort. So especially in the centralized finance, I might go to another participant of the market and ask for equivalent lender of last resort. For example, FTX asked to Binance. Binance examined the balance sheets of FTX and then didn't go forward. But there was a moment where there were some news, some spreading news on the press that Binance could, in reality, save FTX through a private lender of last resort. So this kind of function usually is by central banks, but can even be, in reality, performed by other actors, like private actors. And the centralized finance, for this reason, usually for now, is relying more on the private side of things. Because still today, there is not a kind of position that is clear on this lender of last resort in terms of public assistance. But still, if one day there will be, as you can imagine, there will be a blurring of borders. Because if today we believe that traditional finance is one thing, decentralized finance is something else, the more these two types of finance they become more closer in functions and similar, the more questions will be raised whether we should extend the pillars of traditional finance to decentralized finance. And there are already proposals in this sense, in this direction. The UK is one of them, where in reality, I mean, they're thinking to go closer to this idea. But to go closer in this idea can even create contamination in reality of use. So for now, there was not a real effect of systemic risk that was spreading from one side to the other. Although there were some signals, and the signals were here in these regulatory borders that I now explained. These were the examples. And one of the examples, I mean, is the fact that systemic risk, first of all, spread within the centralized finance. So in the case of stablecoin, Terra, Luna was the token, was the stablecoin. And this stablecoin then crashed. And so this kind of crash at the time put all those deposit and token holders without insurance because they were not actors of traditional finance. If they were not actors of traditional finance, this created a systemic risk that then spread to FTX collapse. That was a non-bank financial intermediary. In fact, it's not a bank, it's something else, it's a non-bank financial intermediary. And then all these other, in late 2022, Lockheed, Voyager, Celsius, they were all failures triggered within this spreading of systemic risk within decentralized finance. But if we look at Silicon Valley Bank, there we can have a signal that the two entities of traditional finance and decentralized finance, they can in reality be contaminated. I mean, that might be something that is touching each other. Do you remember anything about Silicon Valley Bank?
Not considered a systemically important bank.
Yes.
But when it failed, when it was failing, it was important because it was very centralized in one important sector. It was in Silicon Valley and a lot of relationship with companies in that part of the world.
Yes, essentially Silicon Valley Bank was a regional bank in California. It was a specialized bank, so it means that in reality was giving loans. So the same thing of the diagram to businesses, but these businesses and these borrowers were startups. So in reality they focused on financing startups. Then they started to grow exponentially. And in the balance sheet actually of depositors of Silicon Valley Bank, there was a stablecoin provider. that had a huge amount of money there deposited. And once there was then the bank run at that time, this created a panic effect. And so in reality, from the withdrawal of this big deposit of this stablecoin provider, any other startups that started in reality to withdraw money, and that created a bank run. So it means that then the bank didn't have enough liquidity cash to pay all the withdrawals. So what happened in that moment? Yeah.
The par value of those stablecoins dropped.
Yeah, this for sure. I mean, yes, there is always an effect on the market because the stablecoin, in reality, they can, but even other crypto tokens, they might be affected by market events. This, yes. But at the end of the day, the main point there is that that was a commercial bank. I mean, it was a bank, a regional bank within traditional finance. So there was the deposit insurance. So one of the pillars could be used. That actually is the deposit insurance. But we said there is a limit, is $250,000. If we speak about startups, they all had deposit for over millions and millions. So reality means that you are not covered, essentially. This could create a panic effect on other market participants, so the systemic risk there could spread. But even if we think about this stablecoin provider, because majority, 99% of stablecoin today are denominated in US dollars. So if then we let fail a stablecoin provider that has actually denomination of stablecoin in dollars, indirectly the dollar has a currency control. So President Biden signed an extraordinary order where all these depositors they were protected beyond the limit. So insured depositors, if there were some insured, they were protected by the agency of the government, the Federal Deposit Insurance Corporation. Everything above by government itself. And this was a sort of thing that, I mean, should not happen, but it happened because there were links of these two worlds, decentralized finance and centralized finance and traditional finance, that they started to have interconnections. So Silicon Valley Bank, at least for me, is one of the first examples where we can see that there is a possibility of contamination. So if now already decentralized finance is developing, this contamination can always be higher. This is why around the world now we have many reforms of crypto reforms in law, where some rules, all the rules many times, are copied and pasted and tailored sometimes for crypto finance, but they are based on traditional finance. So they take the rules designed for traditional finance, the pillars of traditional finance, and they try to transport this to the crypto world. Sometimes they design a new legal system, and this new legal system is bespoke regulation, completely new, tailored for them. This is quite good kind of initiative in my view. Other times they simply tailored and copy and match the same equivalent for traditional finance in crypto finance. And that is something that in reality can even give more rise to systemic risk. All clear? Any question? Yes.
I have a question.
Yes, of course.
On shadow banking.
Yeah.
John, before, and about the legal form of this deposit equivalent between those financial intermediaries that act as shadow banking. What's the legal form of this deposit?
The legal form of this deposit, you mean the protection of those deposits, if they can create some form of insurance equivalent to deposit
No,
insurance?
I mean, if those financial intermediaries are able to gain something similar to a deposit, what's the legal form of it? We cannot do as a deposit.
Yes, it's a token deposit.
So there's not a limit on the gain of deposit.
But
Like
the limit,
usually in the
yes.
usually is connected to banking license,
Mhm.
but it's not like that. So there's not any
The point is
specific
this, that this were the shadow banking are actors that actually are not a bank, so they don't have this kind of authorization. I mean, the authorization requirements that applies to a bank does not apply to a non-bank, and so the non-bank is not subject to the same restrictions, limitations, but still they perform, and this is the tricky part, they perform still the same function of a bank without being a bank and without being subject to all the conditions and requirements of authorization.
So there's no legal binding rules on
For now,
deposits or specific the form of
no, yes,
deposit.
that is the, yes, in fact all these people, they lost completely money. In the case of Luna Terra, they lost everything, because there was not, they were not an equivalent in legal terms. Now I think I understood the question.
Yeah.
Yes, in legal terms they were not an equivalent, they were de facto,
Okay.
yes, de facto equivalent.
Any
And so,
contractual construction different from deposit?
yes, in fact everything in decentralized finance is based on contract, even a stable coin. A stable coin is pegging the value to the US dollar and is giving you an equivalent of 1-to-1 parity. So if I deposit $1, I should have one stable coin, and then if I withdraw one stable coin, I should be able to withdraw $1, 1-to-1. Now the problem there is that from a contractual point of view, it is not true, because I tried myself even in Germany. I bought a stable coin. I didn't withdraw. I put 10 pounds. I withdraw £9 and 7. So the equivalent one-to-one does not exist, because it's not universal. It's based on contract, market fluctuation, and they don't guarantee this is not true. So that is the main issue there. That in reality they try to perform functions that are similar to traditional finance, but then they don't actually deliver the same. And you can try. You will never have back your money pure, because also Gemini, as a decentralized exchange, is an exchange online, takes a commission. And this is not very well aware. For example, even if I have Ether is one type of token. This Ether can be staked. So in reality you can put, because actually decentralized finance now we will say is based on blockchain. All these different blocks are verified by different people that they operate on the blockchain. So to verify those operations and to legitimize the transactions that they happen on the blockchain, you are a token holder of Ether, for example, and you put back your token into the chain in order to allow other people to verify that all the transactions of the block are correct. To do this, you are remunerated. And this kind of practice that is called staking, in fact, is not regulated. And many people, investors, they think like a depositor. They think it's like depositing money in a bank and they give me interest rate. But it's not true. It's not the same. And so there is a lot of confusion, and there are a lot of rules not in place to take off this confusion. In fact, there are people that invest in this kind of cryptocurrencies, like Ether, and then they think that staking is like taking a high percentage of interest rate just by giving back and block your tokens there in order to other verifiers to verify all the transactions of the block. This is what actually is written. Even if you go on Gemini, this is what is written and explained. But then it does not reflect the reality. It's not like this. If you do this, you will not receive what they promise there in terms of interest rate. And what they say that is interest rate, then at the end is not even an interest rate. It's like a service charge or a service fee. So there is a lot of miscommunication. So what happens is that in traditional finance and in securities regulation, we have many rules that are going, especially in the prospectus, to avoid this kind of confusion and this kind of misalignment. In the case of decentralized finance today, it's still in progress. It's a work in progress. That is the main difference. All clear? So this thing and this thing that you find in the slides, try always to keep in your mind, because actually if you understand those things, you will find out that many of those concepts, they come back in this course. Even Douglas will speak to you again later on during the end of the course about decentralized finance and stablecoin, the regulation of stablecoin. It is just an idea that we discussed today, but you will see in more depth that actually in the world, in the US, in the UK, in Europe with MiCA, they enacted rules. The MiCA regulation was the first actually in Europe to regulate stablecoin. But then these stablecoin, they were not regulated in terms of systemic effect. They gave just a micro-prudential supervision of the entity that is going to issue stablecoin. So these kind of, again, pillars are good, because for example, in the case of MiCA, they took this pillar, the prudential supervision, and so they said, if you are a stablecoin provider in Europe, you are issuing stablecoin in Europe, you are issuing the stablecoin in the currency that is euro, you will go under prudential supervision, and so if we apply this prudential supervision, you will be following, for example, authorization, liquidity buffer. So all this kind of practice is already known in traditional finance. This time will be applied to decentralized finance in Europe. But this is micro-prudential supervision. It's the supervision of the single entity offering the stablecoin in Europe. But then the stablecoin, they can have a macro effect, and the macro effect is not regulated in MiCA. So those kind of contaminations that there are between traditional finance and decentralized finance, they can give rise to new rules. But the majority of new rules, they take these pillars of traditional finance and they try to tailor to crypto finance. But they do in a way that in reality many times is based on micro-prudential supervision and not macro-prudential supervision. So if there is a stable coin that in reality is issued maybe by a company based in the US, but this company then is offering the stable coin in the UK, and so they are pound denominated, this can create systemic risk, because if the law, for example, of the UK only applies to issuers of the UK, it does not apply to the issuer that is based in the US. And so it means that at the end of the day, the final product is a stable coin denominated in pound. And there is no limit in purchasing, because the provider is not a UK company. So there are some things that in reality they can affect the future of money and the future of this contamination. But the solution is not clear, in the sense that there is not one single answer. It depends on the legal system, where those stablecoins are offered and who is offering the stablecoins. In the UK, they are trying to put forward the reform. So here you have then the things about decentralized finance, and those things you can keep for you also the Bitcoin as one of the first example. Bitcoin, Ethereum, Solana, I mean all these tokens, they are a form of private money. Public money are the deposits of commercial bank. That is a form of public money. Public money are the money issued by a sovereign state, and so with an authority that then is provided by who is going to print the money, that is the central bank. Private money is the opposite side, so reality is a kind of form of erosion of public money. So if there are more private money and private providers that they are offering private money within the centralized finance, the same role of traditional finance can be undermined. Because if now stablecoin they take place, maybe the risk can be that many people that today they deposit money in the bank in the traditional system, they will start to deposit money with a private provider. And so that becomes becomes a form of private money that is less regulated, but actually maybe can be more profitable for some kind of operations. This is why also banks today are studying and are offering their own institutionalized stablecoin, because they understood that they need to compete. So another thing is this, that here in this graphic, speaking about markets, trust is the key word. In these other things related to regulation, competition is the key word. Today, the more competitive you are in regulation, the more investors that will come to your country. And so, in terms of securities regulations today, the more competition there is in the market, the better your country could be. But to be competitive, you need to see and look around what others they offer in terms of protection. If the protections, and then this is the tricky part, if the protections are too high, there is less possibility to develop financial technology. If the protections are too low, then there is to risk the financial technology can overtake maybe investor protection. And you need to strike a balance, and that is why it's difficult, and no one has an answer. Even the MiCA for stablecoin, they thought that maybe to give, in a good intention, to give prudential supervision views to stablecoin providers in Europe was good. In reality, as you can see, the regulator has a good intention, but can create unintended results. So, because MiCA didn't think about the macro-prudential consequences of a stablecoin collapse in Europe, if this thing is happening, they don't have the lender of last resort facility, they didn't extend other possibilities of facilities of liquidity to those providers. It's not in the regulation today. And so that is why this can create a problem. Now start to be more clear, the picture. So all these things you will study even more, and you will see the connection even more once Douglas at the end of the course is speaking about the regulation of stablecoin, for example. Centralized finance is always part of this new finance, but is different from decentralized finance. Here is operational on the blockchain. The blockchain is public blockchain, can even be private. For example, JP Morgan can have its own blockchain that is private blockchain, JP Morgan. And so in the blockchain, the public one, the public is in control. You don't need a central bank that issue money. You are creating the money. There are mining companies that they mine stablecoin, that they mine Bitcoin. So these native tokens, they call it the Bitcoin. And then centralized finance. Here there is financial service provided by a centralized intermediary. So it means that there is a centralized exchange or platform that operate off-chain, so not blockchain, off-chain. So let's say that centralized finance is more similar, in fact you see in the picture, is in the design of traditional finance as a bank. So centralized finance is maybe the closer typology of finance that we have today to traditional finance. And this is something that is different from the centralized finance, DeFi, where financial service is automated with smart contracts on the blockchain. And so in fact it's a form of on-chain finance. Centralized finance is off-chain finance. And so there is an exchange. So the role of a clearinghouse in some way is there. But even there, for example, even if you have a centralized exchange operating in cryptocurrencies, still you cannot prevent, for example, operational risk. If the manager of the exchange is dodgy, it's something that sometimes you cannot even foresee. Or what happened in FTX is something that was difficult, as always, to prevent. So until here, everything is fine, no? So we will continue, because then we can have a break around 5 or something like that, so that is coming the lecture, so that you have the break, and then we can finish at sensibility. So coming to soft law and self-regulation, we mentioned at the start, soft law What is soft law in general? Yes, it's a kind of provision, but it's not legal provision. It's not legal because it's not binding. And it's not binding, so it's not enforceable. There is not enforceability. So for this is soft law. But still, it's a typology of law. If you are from the European Union is full of soft law. The European Union was built on soft law. Why? Because there were so many member states that if we need to impose the same condition to everyone, and it's even like a sort of idea of being authoritative, in the sense that it's like your father that is telling you you must come back at 3 again, but if he's telling you in a way that will help you feel more free, you will come back at 9 alone. So soft law can create more kind of negotiations between parties, where the parties they feel in reality more at ease. Soft law is very important within the international financial architecture. So within the international financial architecture, we will find out that there are some typology of standard setters. The Basel Committee on Banking Supervision is issuing standards for banks, for example. The Basel Committee on Banking Supervision is under the auspices of the Bank for International Settlement. And then we have the Financial Stability Board, that is more looking at the macro-prudential supervision of the entire economic system and is detecting whether there is systemic risk in the products that are offered. If there are products offered by a mutual fund or the operation of mutual fund can generate systemic risk, that is supervised by the Financial Stability Board. The Financial Stability Board, in any case, is the standard setter, and so it's issuing recommendations, soft law. So what does it mean? Italy then is obliged, no, is not obliged to follow that. Every state is free, you are not obliged to follow. But then, indirectly, if you don't follow this kind of standards that are suggestions, you might have consequences in terms of international finance. So, for example, if your country is behaving bad on the paying debt that you ask to borrowers, to lenders, at the end of the day, you might ask a loan from the IMF, that is the lender of last resort facility for countries. But the IMF can say no, I cannot give you, or I give you under conditionality that you comply with the Financial Stability Board recommendations. That they are designed for digital assets, they are designed for mutual fund, hedge fund, for many things. And so if your country does not follow that, maybe IMF assistance is closed. You cannot get it. Or you get only to change. So indirectly, if you want or you don't want, you will comply indirectly. So for this reason, within the international financial architecture, we say that soft law is harder than hard law, because actually more people are willing to follow actually. Then IOSCO, that is the standard setter for securities regulation. For example, very recently, 2 years ago, IOSCO issued recommendations for SPACs. For special purpose acquisition companies, there are specific now recommendations that are given to all the regulators, the securities laws regulators of the world. So if in your country, you're in Belgium, you want in reality to issue a new listing requirement or a SPAC reform in your country, now today you should look at the IOSCO recommendation, where it is written the main features that the SPAC should have. So that is what we're speaking about. You must, you don't have to follow, but if you don't follow, maybe even market participants, they will know that you didn't follow IOSCO recommendation. And so maybe rather than listing in your country, they will go to someone else, that they follow the recommendation. So you lose or investors, or prestige, or you are less competitive, essentially. So we said at the start, competition within securities regulation is key today. Otherwise, the investors, they don't come to your country. So those are examples, once they are designed by the standard setter, those are examples of top-down soft law. From the top, the standard setter, down to the market participants. Bottom-up is the opposite. So reality is from, in reality, market participants. If we think about ISDA, that is the International Swap and Derivatives Association, they designed the ISDA Master Agreement that applies to derivatives as financial contracts negotiated all over the counter. So today you need to apply things. I think ISDA is 1986, I got 1986, 1985 it is. Yes, because I got the year. So that is the time of ISDA, once it was set up. Then the participation of ISDA was only banks at the start, but today there are government entities, government itself, market participants, so it's law forms, and they design the ISDA Master Agreement. If you will follow the course of derivatives, you will find out also, and there is a special class with a lawyer from Vincent and Mason that will show you page by page how the standard that is designed by ISDA, that is soft law, it is an example of bottom-up soft law, how it is written and how you should work on it. So the class is quite specific but also unique, because actually even if one day they hire you 1 year and you start to work in derivatives, no one is teaching you the job in this way. While in is coming and is telling you already, if you have also printed the ISDA Master Agreement, you will have, you can finish the course of derivatives with 1 copy or with notes so that you can take already good for the job, for example. So the thing of me and Douglas is that in reality with connections we can bring people even that apart from our knowledge here, they can give you hands-on on things that then you can use in practice tomorrow, essentially. And only specialized in that thing, like this partner only in ISDA Master Agreement. So it's the best on that, essentially. And that is how we take something that is more unique in some way, rather than only listening to lectures that you might have read the book, but in reality, I mean, it's better from the lecturer sometimes, but that is how you have the extra bonus, essentially. So these are, just for your information, how they are divided. This example of top-down soft law, bottom-up soft law. In the case, for example, of listing requirements of an exchange will be top-down soft law, because it's the exchange given to market participants. They might write guidelines, investor guidelines. This is something that will be top-down soft law designed by an exchange, for example. Yes?
I just wanted to ask, doesn't the fact that we're now relying heavily on soft law, especially like in this industry, doesn't that undermine the say some like the rule of law?
The rule of law?
So we have like the statutes and
Undermine, yes, there are some, more than the rule of law, there are some people that they speak about democratic deficit. Because essentially, if I work for a IOSCO, I am Professor Dalia, but in reality, no one has elected me to design the standards in a IOSCO. Even Douglas had a meeting with the IOSCO very recently, was changing the power. So the information of Douglas and this knowledge that Douglas shaped with the other people at the table design will be a recommendation, set of recommendations. But this was designed by Douglas. No one has selected Douglas to do this, but these things that Douglas has said and has written as a recommendation will be applicable to many companies in the world. And that is why they say there is a democratic deficit. Also, the same can be in Europe, in all the agencies of Europe, European Union. All these people are not elected, but people that they are there because they have a specific knowledge, like Douglas, myself, and so reality, I mean, they are experts masters of the subject, but then becomes a technocracy. That is why they don't like it. It's no more something based on democracy. And so for this reason, yes, they claim this democratic deficit within soft law. Then with this soft law, there is also the case of self-regulation. So the fact that market participants itself, they can impose to themselves a form of rules. So there's a type of soft law, but this time is coming from market participants themselves. So the case of ISTA is a form of self-regulation. It is market participants, they go together, they design the ISTA master agreement. From tomorrow, all the market participants that they trade derivatives OTC, they will use that standard. But that is something that they do as a form of self-regulation. Self-regulation is not very popular, because in reality, the people, they say, the criminals, they will not design the rules that will be applicable to themselves. You are a criminal. So in reality, in the period of crisis, in the period of the global financial crisis and many other crises that will follow, people, they are not pro self-regulation. They are pro regulation to court. Regulation, that is the enactment of rules. Supervision, that is the implementation of the rules. Self-regulation is more soft, is something that in reality can even be derived from market practices. But sometimes it's also true that while the regulation it is enacted by a regulator that doesn't have a lot of information of the market participants, they have more information about the market. So maybe the level of sophistication of self-regulation may be higher than regulation. This is the reason why in common law countries like this one, in fact, and then this kind of approach was extended also to other countries, but especially this one in the US, they started to speak to each other. So in reality, the regulator started to issue maybe a call for evidence or something where all market participants they can give suggestions. The regulator take the information and then issue the regulation. That is based also on the knowledge. That is a mixed approach. It's a mixed approach of regulation. In fact, some people, they call it hybrid regulation, because it's mixed. It's not only coming from the knowledge of the regulator. And today is something very common, this approach. And this is also, I mean, in the UK especially, they designed many times also, you will see for IPOs, this principle-based approach, but a principle-based approach with people that they have non-principles does not work, in the sense that, as I told you before about the criminals, so the self-regulation has not always been something that maybe was very good for market participants, but not a lot for regulators. This again is just a summary of the market of the standard setters, so just to have a list in mind. Even IMF or bank are standard setters. And here you have the main diagram, how it works. The one that usually they monitor whether the recommendations of standard setters are implemented is the IMF World Bank. So they carry out a peer review every 6 months or annually based on countries. And so here in relation to different sectors, securities, you have the IOSCO, anti-money laundering, this is quite important, you have the Financial Action Task Force on the 40 and plus 8 recommendations, that they also target the financing of terrorism, for example. For banking, you have the Basel Committee on Banking Supervision, and so on. Insurance, the International Association of Insurance Supervisors. So I mean, each sector, insurance, securities, and so on, banking, they have their own standard setter. And IOSCO is the one, I mean, relates more to us, because established in 1983, international body, global standard setter for the securities sector. So every time that you see IOSCO, it is based in Madrid, so in Spain, and it has this overview of capital markets in the world. So even if you read the recommendation of SPACs, special purpose acquisition companies, there you find by IOSCO everything that relates to SPAC and everything that relates to them international. So they look at different jurisdictions and then they say those are the standards that everyone should follow. Usually based in the case of SPACs on the US. But generally saying, once we speak about securities regulation, it's always based on the US because securities regulation born in the US by the Securities Act, Securities and Exchange Act, that is where it's coming from. So for this reason, then what happened in the crash of Wall Street and after, once these kind of acts were approved, at that moment in time, then the US expanded also the influence in the world, because if you remember there was the Soviet Union and so on. So some countries, the countries of Soviet Union, they were not really capitalism. So a way to make publicity of capitalism through the fact that companies they can issue shares on the market could be done by the US through IOSCO. So IOSCO was like an extension of the dominance of the US in the world. And many times, in fact, they only speak about US regulations and that the world should follow the US regulations. But why? Because also financial innovations, the majority are US, are based in the US. Even the SPAC bought in the US. Even, everything related to derivatives in modern terms of CDS, credit default swaps born in the US. So all these financial innovations, CDOs born in the US, and there are many others. Also the exchange traded funds, even that they born in the US, and in modern terms is there where everything developed. And so every type of rules that applies to them in the US then is extended, copied, and pasted by other countries in the world. In this main, if you want to have a read, you can find online, is the IOSCO Objectives and Principles of Securities Regulation. You find in reality the basis for the evaluation of securities sectors for these financial sector assessment programs that is carried out by IMF and World Bank, and is carried out to understand in each country how much fulfillment there is, compliance there is in relation to the standard setters. In this case, in the case of IOSCO. And so the principles, three objectives of the IOSCO are here in bold: protecting investors, ensuring that markets are fair, efficient, transparent, and reducing systemic risk. So they want always this kind of idea because the standard setter are within the international financial architecture. So they always look at systemic risk in general terms, even in terms of money laundering and anti-money laundering provisions, is also to avoid systemic risk. Then other principles, in fact these are just examples. In fact you see, for example, the international disclosure standards for cross-border offerings and initial listings by foreign issuers. The SPAC is another. There are many others that you can find of recommendations online by IOSCO on different typologies of digital assets, for example, if they are offered in the form of securities, for example. So this is what I wanted mainly that you know. What is a standard setter within the international financial architecture? What is the role of soft law, top-down, bottom-up, self-regulation, and the role of IOSCO even politically, that essentially was to extend the power, the influence of the US. So this something, I mean, you can read for yourself. Is more related to other examples of IOSCO standards, essentially. Do you want maybe now the break, or I can, because I see it from the faces, before I start with security. So let's have a break now, yes. Right.
My question is, nice to meet you. I have a question with respect to mutual funds. In the country where I come from, India,
Yes.
we invest in mutual funds. We do not get to know as investors where we are investing because the money is being allocated in debt equity or in long-term or short-term. We have no clue. So with respect to UK and EU or the US for that matter,
Yeah.
do we have the access of investors disclosure where the capital has been invested in mutual funds?
So the question is,
The question being, does the
Yeah.
investor is disclosed about his capital being invested or where it has been bifurcated? And for example, equity, which company in the equity
yes,
shares are
this
required?
yes,
Because where I come from, we have no information about this. We just pay. There is an intermediary, an asset manager, which send the money, and we have no knowledge which sector is involved in, which company is involved. We have no disclosure as an interest.
yes, this can be possible. In reality, you mean if you are a mutual fund, I put money in the mutual fund,
Yeah.
I take your money, then I find some companies and I invest, but I don't tell you the name of the companies. You don't know the name of the companies I invest in. This is the point.
Yeah.
This is not illegal.
That's
Can be done, but usually it is done by telling you that you need to trust me, you need to trust me as the manager, that I carry out an analysis of risk, and I say this one is more risky, this other is less, and then I come back to you without telling you the name of the investment, but
Which is the
telling you
best
the
one for
grade,
you.
the grade.
Right.
If you tell me I risk, I tell you that you can lose all your money, but if you still give me the mandate, I go for it.
Isn't that unfair for the investor because the investor is not disclosed where his capital
But
is being going?
in reality, it's not unfair because you have decided to invest with a mutual fund manager. If you want, you have Barclays app, you can invest in your own.
I mean,
You didn't want to do that. Because there you can buy whatever you want,
okay.
and you do alone, and you know the name, and you know everything. But if rather than putting money in a bank, you have more money, or you want to open an account with a mutual fund, you can.
Because I just thought that it doesn't feel investor is disclosed about where his money is going. So I have a question: should that be given or not? But then, as you explained that it's not right to tell them because you can just go yourself and do one other interview.
Yes.
Doesn't that defeat the purpose of investors protection disclosure?
This
Mutual
depends because, the main point of the investor disclosure is the fact that you need to disclose in what you invest, but usually on the level of risk that you take and what are the consequences for them to take that path of investment.
Not naming the companies of where the
The name of the company is not so important as far as you give this grade of risk.
high risk.
High risk, low risk, and what can happen to your money. What are the fees that I take from you? Because that is disclosure. The name of the company is not so important, but of course, if you don't arrive to know the name of the company,
Then it's better you go up yourself.
that is more risky. Because the name of the company is key, and if you want to invest in reality on that company like Apple, but in reality you can do alone through a broker. You don't need to go in a mutual fund to do this.
Makes sense.
That is just more a form of accumulation of capital in a place that is giving you a form of return that is higher than a saving account. This is how you should look at it. It's more this
Rather
than yeah.
Thank you.
Okay.
Hi, sir. I just had two very small questions. The first one was you were referring to a company when we were speaking about the shadow banking, the crypto bank. What was the name of the bank? I didn't quite.
Chelsea.
How can I spell that? Is it the Celsius network?
No. Yes. Yes, this one.
And then I just wanted to ask, how long is the break supposed to be?
How long?
Is the break supposed to be? The break that you just gave us? How long?
Ah, no, like I mean, 10 minutes or 15 minutes.
So when do we come back?
Like I hope that they come back because we need to continue.
Oh, okay. Okay.
I hope they come back, but you have time if you want.
Yeah, I just want to step out cigarettes.
Yeah, yeah, you can.
Thank you, sir.
The break is of 10 minutes.
Yes.
So because of restructuring, so we basically the bankers are now in front. But I can check. Yeah. So yeah. Yeah. Okay. I will check with what is the
Yes, they Spar, but they are even open to other ideas as far as then they can buy in London. So, for example, if it is Paris, Euronext, they are not against. I mean, they want just to hear from some investment bankers.
Okay. So it's just
Some
not
option.
necessarily LSE related. It can be okay.
So, for example, can even be Paris Euronext.
Yeah.
It is not, yeah.
Sounds good.
So the idea is that they were a bit tired, so I gave a bit before the break. Now I just wrap up with some securities regulation,
Yeah.
and we can start with IPO. That the slides are just there.
Sounds good.
So it's not long. I mean, I will go quite fast just to give them an idea,
Yeah.
and then basically we start with IPO. But already in the first hour we spoke on things even in the financial history, the VOC, the first IPO, and the idea why you do an IPO a little bit. So potentially, I mean, I think
So if you see something in my slides that you already discussed, you
no,
just
in fact your slides are good because you are going more towards corporate finance. That is what is perfect. The
okay.
approach is
I'd
perfect
also just want to make it like practical
and practical.
and like not really like drafting session on the prospectus, but more of like what kind of considerations are there for the company, where do you want to list, which market, what are the typical documents, and look at the UK regime, just kind of highlights of different aspects.
Exactly.
And I want
That
to
is
ask
what we
like
do.
what people are, is anyone doing any of this or?
Yes, they are almost full room. Now a little bit they are coming because they have this kind of break. But I think we can even start so that then I put your slides and we have enough time also for Q&A at the end.
Yeah, I actually when I go, I just go like it's a flow straight away. Like, and then, like ask people
Yeah,
to contribute as we go to
Sometimes.
make it more
Yeah.
interactive, rather than like wait until the very end. So,
exactly, yes.
So
It's perfect.
yeah, but what time do you guys want to finish?
6. But even a bit more than 6. If there is no other class, even if it is 6:05, 6:10, it's not a problem. Yeah, microphone. Okay. Yes, okay.
With the recent change in my modules, I don't have this module attached to my
Yeah.
So can you somehow record my attendance for your end?
You want to be auditor of the model.
No, I want you got my attendance because.
Yes. Yeah, we can do that. Can you come back to that?
Yeah, sure, no issues.
And we can do. So, guys, we can start again. So I will go quite fast here in the sense that now the idea is because the guest speaker lecturers came to us, I would like to dedicate more time to him and to the initial public offering. In any case, we meet next week. So next week I will be here and in fact maybe we can start from this part that is more the part of the UK, because I need to teach you in any case the Financial Services Authority, the Financial Conduct Authority, and it is something that already he will speak in the IPO, in terms of IPO, exactly. So here is just to wrap up, because we did the IOSCO part, and then we explained or mentioned a little bit about the Securities Act 1933, Securities and Exchange Act 1934. So this is something quite important because are fundamental acts of securities law in the US, and those are the acts that actually then were copied and pasted in other jurisdictions, so in other countries of the world, that they took them as a model. In that time, of course, those acts before 1933, in fact, is very close to the Crash of Wall Street. That is a universal, let's say, legislation, more at federal level. But then each state can have also its own rule and regulations. The Securities Act 1933 is more like a sort of poem where in reality is giving you the guidelines, the principles of disclosure, the principles of investor protection, of what is a security. You will find this there. And then more procedural rules and also regulation of the exchange itself is on the Securities and Exchange Act 1934. And so the regulator in charge of implementing, supervising those acts is the Securities and Exchange Commission in the US. And then in the US they have this dual mandate where in reality there might be also derivatives products that they look like securities, but those kind of hybrid, they are under a dual supervision, sometimes from a specific supervisor that is only deputed to supervise derivatives. So commodity futures trading commission. So they have jurisdiction over this other typology of products. So they have a bifurcation of regulatory oversight, something that in the UK, I mean, is not completely the same, although there is this Twin Peaks model that we will see next week, essentially. Why, for example, this is something that I mean, relates to the fact of the crash of Wall Street, relates to the fact of financial crisis, financial scandals. We need to detect fraud. So the main way to detect fraud, if I offer securities to the market, is that I am obliged to disclose much information, more information to market participants, to investors. Some information are in the public domain, and so everyone can look at it. Some others are not, and so this is why there is disclosure. The main type of disclosure will be through some specific forms, for example, in relation to annual statements, quarterly statements, or extraordinary operation. There are all different forms that you need to fill in the US. The S1 form is the prospectus. So in reality, the prospectus is that main document where you find all the information of the issuer, the key factors, the risk factors is one of the main section where you find all the risk of investment, and that is a form of disclosure. So this is just to tell you that once now we go in IPO and we look at prospectus and we look at disclosure requirements, this is what it means. It means that in reality is a form of protection for investors if you disclose. It's also true you can disclose information that are not true, but there will be consequences for misinformation, because you have in reality maybe you were listed and you said that you could acquire a company and this company was the next Tesla. In reality it was not, but you dragged the attention of investors for this reason, and then maybe the company that you acquire will be delisted. That is a failure for you, but especially for investors. So this can trigger litigation, essentially. The level of litigation is more in the US in comparison to Europe, for example. So we are less litigious, but also it's less common here to invest in securities. That is more common to invest in securities, and it's more common even to litigate. In fact, if you go in the US in a course of securities regulation, there is always several lectures on securities litigation. So that is something that you will find more commonly in the US, less in Europe. Having said that, I mean, I think these things we can come back together. If you want, you can start to have a look this week. But next week we will start from what we missed or didn't finish, and we will add other information about Financial Conduct Authority, Prudential Regulation Authority, and the environment of the financial architecture in the UK. So, without further ado, I think I give the floor to the guest lecturer about IPO. So IPO, if you remember the VOC, that is what we were speaking before. So Kirill, will be here is from HSBC. Before it was from Amro Bank.
ABN AMRO, yeah.
Exactly. Yes. And he's also a former student of Culinary.
Yes, I am. Yeah.
So-
I'm an alumni.
Exactly. So any question you can ask also. As you can see, you can be hired in very high positions, so it's good.
So is it just clicking?
Yes, it's just like
Oh, yeah,
this.
okay.
Yes. But
Great.
we can put maybe. Let me see if I can put this.
Slide.
Yeah. Yes.
Okay,
Like this.
great.
And then, you can.
Okay, perfect. So my name is Kirill. So I studied LLM here back, I don't know, 2005, so like over 20, was it 20 years ago?
Yes.
Oh, wow. It's been a while. And so I worked kind of at Lec2 as a finance lawyer for about 10 years. And then I moved in-house to ABN AMRO, which is a Dutch bank, where I was supporting an investment banking business there from a legal perspective. And then recently, just a couple of months ago, I joined HSBC. And today I'm going to talk about IPOs, and I think the kind of focus would be not on detailed drafting requirements, but I want to discuss kind of general concepts of IPO, why companies do IPO, what is usually required for IPOs, touch upon documentation, yeah, I just wanted to have this discussion with also from a more practical perspective, and a little bit from a commercial perspective as well, because often our clients complain about lawyers being too legalistic, but forgetting about larger picture. So I wanted to make it a bit more practical, and I also want to make it interactive. So I don't know how many of you been involved in IPOs at all. Can you let me know? Who have you
But in the governance structure.
in
The governance structure.
in the governance structure? Okay. Is anyone else? Okay. Well, if you have corporate backgrounds or been involved in any aspects of IPOs before, please feel free to add any views from your side, or jump in, ask questions, make comments. I wanted to make it fairly interactive. So in terms of the agenda, we're going to talk about why companies do IPO, where to IPO, and we'll look at a brief change, sort of comparison between UK regime, US regime, and European regime. Then look at the key parties involved in the IPO process and the typical IPO documentation. The key document is obviously prospectus, so we'll spend a bit more time on the prospectus. And then finally, in the end, we'll also look a little bit at the life of the company after the IPO, because it's also relevant. Can I ask you guys, what is actually IPO? How would you define an IPO?
When a company for the first time makes its shares tradable to the public.
Yeah, exactly. So it's an initial public offering of shares to the public, and it's done with a view of raising money, right? So it's a finance event. It's also a major governance event. But indeed, so that's the kind of gist of it. So why companies do IPOs, right? So first of all, it's access to capital, and by capital I mean quite large amount of capital will be available to the company if it does initial public offering of shares. It is also an opportunity for private investors to exit, right? So many private companies are owned by shareholders or investors who want to make profit on their investment, right? So they bought the shares of the company, they make it grow, and now it's at the moment when they may want to list it, right? Raise more capital and exit at a profit. Also, it's an important step for the company to become more visible, right? Because when the IPO happens, you see interviews with the CEO, you see information coming from analysts about this particular company, right? So it's a major event for a company, and also its shares, once it's listed, it's used as acquisition currency. So which means that if the company is listed, when it wants to buy another business or other companies, and actually can use its shares as a consideration for the acquisition rather than using its cash. So it could be another reason to do an IPO. And you mentioned you've been involved in the governance aspect. So indeed, so that's also a governance upgrade for a company, because listed companies are subject to strict governance regime, meaning they may need to have independent directors on board. Chairman should be independent to the CEO, and there might be some other governance requirements as well. However, there aren't only kind of advantages to an IPO, but there are also disadvantages or trade-offs, because IPO is not cheap. You have to pay lawyers, you have to pay accountants, you have to pay bankers, to underwrite an IPO. So it's a very costly process, depending on the stock exchange. Because in the US is probably the largest market, so things will be a bit pricier there. And then in London might be a bit cheaper, but also there are different markets, so it's expensive. Then also the company is then exposed to market volatility, right? Because the shares are listed. If something is happening with the market, right? You mentioned financial crisis in the US, right? In the 1930s. So the market went down. So this all external events, they may have an impact on the company. And finally, also, the company will become subject to a lot of scrutiny. So if there are some issues, I don't know, there might be some major litigation, etc. So the shareholders should be prepared to disclose all this information to the public, right? Because that's one of the requirements of regulators, that the company is transparent if it's listed. So that's another consideration to take into account. So it's not just a kind of legal filing to make shares tradable on a stock exchange. It's a major event in the life of the company. Are there any comments on this? If not, I wanted to briefly also discuss difference between initial public offering and private equity capital, because one type of capital is public, another one is private, and there is a difference between the two. When companies decide whether to attract private investors or private equity like KKR, EQT, or alike, or whether to do an IPO, one of the considerations is amount of capital needed, right? So the bigger the requirement for capital, the likely you may need an IPO, right? If it's less of a requirement, sort of the company needs less capital, it may just use private equity or private capital. Then also the question is, are the shareholders open to other shareholders obviously owning the company? And are they going to be happy to give some control to other shareholders? Timing is also important, because IPO takes time. It may take up to 2 years, including preparation for an IPO. So that's another consideration. And finally, the readiness for scrutiny, which I mentioned earlier. So these are important considerations. So when it comes to IPO, it's obviously give access to the broader capital pool, and the company's profile become public. Whereas when it comes to private capital financing, it might be done quicker, it's confidential, and there's a less disclosure requirement. I just wanted to ask you, and there's no wrong or right answer. On the basis of this information, if you think about, for example, a tech company like Microsoft, but is not yet listed, would you recommend it to access private equity or an IPO? And would your answer be different if you, for example, infrastructure company, which is, for example, water company or fiber company, internet or telecom company? Do you have any ideas which you would prefer if you were on the board of directors? Yeah. So, well, yeah, I mean, it depends on which stage the company is in. If it's yeah, but it also depends on how fast it's growing. If it's,
also depends on how quick they need the money.
Yeah.
Markets provides quicker capital than IPOs. IPO can take a year.
yeah.
Really, there's not enough information provided.
What would you like to know? What would you?
For how long they need the capital.
Yeah.
If there is equity or debt, quick they need the money.
Yeah, I think
They
that
don't have a good relationship with the lender.
yeah, that's the right questions to ask. I think private equity guys like actually they really like infrastructure business because everyone buys water, electricity, like internet, so they like predictability of cash flow. So like from private equity perspective, they may actually prefer to go with infrastructure company, but equally if they need like money urgently, right? This is also maybe applicable to a tech company. And similarly, the tech company may decide to use private equity first, and then they can do listing. So it really depends on which stage the business is in. Are they kind of growing fast, or they just need like a smaller amount of capital? So these are the valid questions to ask. In terms of where to IPO, in the UK, there are two key kind of markets. The main market of the London Stock Exchange and the AIM market, or the alternative investment market. So again, there is a decision to be made by the board where they want to list their shares, on the main market, or on the alternative investment market. And the difference is again in cost, in how much capital they need to raise, and also it depends on the kind of size of the company and its track record. Because for the main market, the requirements are very strict. So eligibility criteria are quite high. The governance expectations are also quite high. But in return, it gives accessibility to a larger market and well, larger pool of capital. So these are the main two markets in the UK. I don't know. Do you have any questions on this, or any comments? And this slide gives some brief overview and comparison between US, UK, and European market. This is an example of, obviously NASDAQ, New York Stock Exchange in the US, London Stock Exchange in the UK, and in Europe there are multiple markets like Euronext and so forth. So in terms of liquidity and access to the capital, US is the biggest market. It's about 70 trillion US dollars. It's huge. Whereas UK market is actually much smaller. I didn't realize that, like it's only 4 trillion. So it's like almost 20 times smaller than the US market. Indeed, the US market is very developed. People really accustomed to investing in shares. I don't know, when I've done my share trading, I also kind of invested in the US market, and it's also quite litigious, as you rightly said. Yeah, there are various considerations for the company to take into account when they decide where to list, right? So it's about liquidity, it's about the cost, and it's also about regulatory burden, right? Because in the US, the market is highly regulated, so it's a tough market from regulation perspective and from a cost perspective, whereas in the UK market is less regulated and it's a bit cheaper, and you have a bit of a kind of mixed picture in the EU. But one thing to bear in mind in the EU is that there are 30 different exchanges in Europe. So you may want to kind of shop around between various jurisdictions, depending on what kind of customers you want to target, what is the regulatory framework, and also what sector the company is in. In terms of the IPO timeline, really in terms of the formal process itself, it's only 3 to 6 months, but it's still quite chunky. But in terms of the overall process, including planning for the IPO, that can take like anywhere between like 1 to 2 years and even longer, because it depends on how ready the company is for IPO, right? If it has proper governance in place, if it's really taking care about its financials, right? And there aren't any kind of issues with its financials, right? All of that takes time to set up and prepare. Okay, let's assuming that the company is more or less ready to go for an IPO. So first step in the process will be to do due diligence, because companies to hire lawyers to assist them with preparation of the documentation, right? So you guys potentially will be helping company to organize a due diligence process in terms of the financial due diligence, legal due diligence. This is where lawyers come in. Once due diligence is ongoing, maybe at the same time, then lawyers will start drafting documentation, and also the verification process will kick in, because it's really important for the company and its directors to verify all of the statements about the company which are going into the documentation addressed to the public, in particular prospectus. I don't know, have you seen, presumably you've seen prospectus before? It's
Yeah, you can show.
you
We didn't show, so you can show.
I can show you. Yeah, well, I mean, I don't know. Feel free to pass around if you want, but it's how many pages? This is 216 pages. This is Deliveroo, right? IPO in 2021. So I can maybe show you. We'll discuss prospectus in a bit more detail, but I can show you how it kind of looks. It's on the cover page, it would just say this is prospectus for this company, and this has been prepared by with support from the various kind of investment banks, and then it will include their names here on the cover page, right? The Goldman Sachs, JP Morgan are the usual suspects been involved in the underwriting, and then it will include, you know, information about the company, its historical financial information, and projections for future management and so forth. So that takes time to draft and then verify, because everyone will need to be involved in verification, pretty much every single statement in this document. So that's why it costs lots of money. Then there is a marketing stage when the company is marketed by bankers and the company to potential investors. Pricing will take place, admission to the relevant market, and then once it's listed and things kind of calm down, then the life of a listed company begins, and then there is a further work to be done around ongoing obligations of a publicly listed company, because publicly listed companies are subject to a lot of scrutiny. So there's a lot to do in terms of ongoing obligations. Is there any questions at all, or any observations? So when I was a student, I studied securitization, and I loved this topic. And because I don't know whether you guys covering this as one of the lectures, but I loved it because it was true sale and analysis, and I thought it was so analytical. So I would join Linklaters, and I was like, okay, I need to do securitization. This is my seat. And then they put me in capital markets seat to be involved in securitizations, and I was asked to be involved in the prospectus drafting. So my job was to, like, every time there is a new version of prospectus, I had to check information about the group structure and the company setup, and check every time, like, on which pages it is, whether it covers the relevant kind of requirements of the regulator. So it was really kind of tedious exercise from you know, really kind of drafting perspective, but it just shows, like, you know, often how kind of theory differs from practice a little bit, but also it's a lot of work to put this fat document together. So in terms of the parties involved and who does what, obviously the company is a key player, right? The issue of the prospectus is a key player because they develop strategy. The directors are also accountable, right, to investors if anything there is wrong and the investor made an investment. I don't know, have you guys been investing anything at all? So, I mean, I once bought shares in the research company which was developing a new testing kit for skin cancer, and then everything was like looking very interesting, exciting at the beginning, and then they found there was a publication of updated financials because there was a mistake in the financials. Then the shares started kind of slowly going down, and it was one thing after another. And then I got lots of messages from lawyers saying, do I want to join the class action against this company? Eventually it went bust, and I lost all my money. But which is that, I mean, I learned my lesson. So don't put all the eggs in one basket. You need to diversify, you know, what you invest in. But yeah, I mean, the board is accountable, right? Because otherwise, if there's something is not right, is not accurate, then the lawyers will come after you and then will speak to all of the investors and ask them to join in the class action. All right, so apart from obviously the issuer of shares, banks and underwriters, Goldman Sachs, all these people on the cover page, they're also going to be involved pretty much in every single IPO. There's sometimes, I guess, maybe on AIM, companies maybe do it without investment banks, but there will be some brokers involved anyway. So banks are involved because they know investors, right? So they help to price the shares, to kind of to build a book of the potential kind of investors. Sometimes, well, not sometimes, they also either do it on a best efforts basis or underwrite, which is how they make money, because underwriting fees are expensive. So to the extent that the shares are not sold, if it's underwritten IPO, then the banks will be required to purchase the shares in accordance with the underwriting agreement. Then lawyers are involved, so every single party pretty much involved in the IPO will have their own counsel, and they have obviously different clients and different interests. Accountants are key players in an IPO because they will be verifying financial information, giving comfort letters, and signing off on the accounts. And obviously regulators are also a key player, right? In the UK it's FCA, because they give an approval and they oversee the process. And what's key is that all of these parties need to cooperate smoothly. I guess lawyers will be running with a kind of overall coordination process with the issuer, but it's quite important that everything is done sort of simultaneously, and it needs to run smoothly, because otherwise it have an effect of one thing after another, and delays after delays, like in the construction business. So yeah, these are the key parties involved, and I believe it's quite kind of lucrative business for law firms. So it's a good topic to be familiar with if you are interested in corporate law career. So moving to documentation, because obviously as lawyers this is our favorite topic, right? Prospectus is the key IPO document, which I showed you earlier. So, and we will touch upon some of the key aspects of the prospectus as well. But another key agreement is underwriting agreement with underwriters, and that agreement will include representations and warranties from the company, because underwriters want to make sure that the information provided to them from the company is accurate. So the company will need to rep that the information it shares with underwriters is true and accurate in all material respects. Obviously, in consideration for the underwriting, banks will be paid fees. Company will have to indemnify banks for any potential kind of losses because of their involvement in the IPO process. And some of the other key terms will include termination rights. So if, for example, there's a material disruption in the market, then the underwriters have a right to terminate and exit. So they will be looking for some protection from their perspective. Another set of documents include engagement letters and mandate letters, right? So if you involve accountants, you need to sign accountants' engagement letter, where they will also try to protect themselves. That's another type of kind of set of documents on which you may need to be helping your clients as lawyers, because accountants will try to exclude their liability, include caps on their liability and so forth. So that's another set of documents. Comfort letters are provided by auditors to give comfort to the underwriters or purchasers of the shares and then they just basically confirm accuracy of financial information. And then there will be a bunch of other documents, including corporate approvals from the company in respect of the IPO. But this is just a brief overview of some of the key documents, because if you think about like the real checklist, it's probably going to go for like 100 of different items. It's because it's a lot of documents to deal with, and this is just a brief overview of some of the key documents involved. Am I going at the right pace? Is everyone? Yeah. Okay, good. So in terms of the prospectus, right? Why do we need prospectus?
Consumer protection.
Yeah, it's to give main protection to the investors. It's a main disclosure document, right? So investors need to make informed decision. They need to get information about the company, about its business, about its management, about its business model, about its accounts. So it's a key document for benefit of the investors, and it's basically I guess the more serious IPO, the more information you will find there in the initial prospectus. Sometimes if there's additional share issuance, you have supplemental prospectuses, which are obviously just shorter, showing what changed since the date of the original prospectus. But yeah, the original prospectus would be quite lengthy. And in terms of key points to remember is that it's, on the one hand, it's a legal document for which boards and directors are accountable, but at the same time it's kind of a marketing document. So you have to balance between marketing something and also presenting very accurate information for which you might be accountable. So it's a bit of a tricky balancing act. And one of the reasons we're kind of just discussing maybe the key principles from the documentation perspective is because the UK regime around prospectus and IPOs is changing. It's just changed literally back in January. So it's a very fresh new regime, and the market practice is still kind of hasn't formed around it. So it doesn't make sense to discuss with you the old regime, and the new regime is just being adopted. So I will briefly going to tell you about the key changes to the UK prospectus regime. It came into effect on the 19th of January, basically just a month ago. And the old regime, which is the UK prospectus regulation regime, has been completely repealed. So back at the time of Brexit, all of the European legislation, which has been kind of part of English law, was embedded into English law, right? And since that time, we had this, this version of regulation which is quite similar to European law for a number of years. Now it's been completely repealed, and there is a new set of rules and regulations. The key one is public offers and admissions to trading regulations, 2024, and then it gives rights to FCA, which is a key regulator in the UK, to set detailed prospectus rules, and they updated and created regulated market source book where they include more detailed requirements in respect of prospectus. And then there have been some consequential changes to the Financial Services and Markets Act. I don't know whether you covered FSMA. It's all not yet. Okay. So some of it may kind of be a bit more detailed, but this is just the key overview of the new regime. But in terms of what actually these changes are aimed at, there is now general prohibition on public offers unless there is an exemption, right? So you basically, no one is allowed to offer shares to the public unless it is maybe to qualified investors, being sophisticated investors, or investors kind of investing more than 50,000. So there's a general prohibition on offering shares to the public, and then the law gives specific exemptions which may apply. Another kind of interesting change in regulation of prospectuses and IPOs is that there is a new rule which helps with forward-looking statements about future of the company, because as I said, it's a bit of a marketing document. So company may want to include information about its future projections, and historically companies directors been hesitant in including forward-looking statements because of potential liability for misrepresentation, misinformation. So the new rules reduce liability for giving the forecast and forward-looking statements if these statements comply with certain requirements. So they should be expressly identified as forward-looking statements. Then there should be a cautionary language, and they should be made in good faith. So and if these requirements are complied with, directors will only be liable to the investors if they're reckless. So it's a higher threshold, because otherwise the usual threshold is negligence. I don't know again if you covered.
Actually, all things about prospectus is more about today, because that is more than on corporate finance.
Yeah.
Corporate finance, yes, is sometimes very bad.
Okay. So
So you are more free, like if you want to share more, or if there is interest in some provisions that you want, we are more, maybe in this way is more practical for them.
yeah.
Yes.
Okay. So yeah, I don't know if any of you are doing corporate finance, but yeah, if you have specific kind of questions, we can also discuss it after the session. But in terms of the key overview of the changes, these changes kind of are aimed at making IPOs more popular and making it easier for companies to do IPO, because it removes some of the tension and potential liability of directors for including information in the prospectus. In terms of the content of the prospectus, I mean, this just gives you brief examples of some of the key sets of information which should be included in the prospectus. It's obviously information about business model of the company, about its strategy, but also it should talk about risks for the investors. That's it's one of the key elements, because investors need to know what are the risks associated with this specific business. So, FCA specifically prescribes, what kind of risk, what are the requirements for those risk factors. So they should be quite specific, they should be material, and they should be credible, in order for the investors to make an informed decision about the company. There is also a requirement for financial information to be included. Normally it would be like historic financials of the company. I don't know, if the company is planning to do some acquisitions, there might be some pro forma financial statements included which take into account potential acquisition. There will be section normally about about the management, and then material contracts of the company, because obviously investors want to know what are the key contracts and key business relationship of this company which can impact on its success, right? So, and when lenders are doing the analysis, when they're lending to the company, they do the same kind of analysis. So all of that will be done by by any financier, but because it's a public offering, then the company needs to kind of volunteer all of that information to the public. So that's usually the kind of key difference between between maybe like private debt and private equity and public debt, because there is a requirement to disclose by the company information to the relevant investors. And then finally, there's also a bit more focus on ESG, because that's one of the key areas of interest for the regulators and for the businesses. So there are specific requirements in respect of ESG aspects of the business. Are there any questions on the content? Would you like me to shall I pass it on? Do you want to have a look and just pass around so that it's a bit more practical as well? In terms of liability and due diligence from the prospectus perspective, obviously the key risk is that there might be incorrect information and omission in the prospectus which then lead to liability of directors. As a result, the due diligence is a key part of preparation of the prospectus. So, I mean, when the company involves lawyers and auditors and accountants, then they will be provided with access to, I don't know, digital data room, where the company will be providing information about its business, and then every single line in the prospectus will be analyzed have a given specific number, and there will be allocation of responsibility for that statement. For example, the company has 150 employees. That will be allocated to HR department to verify, right? So the company made X profit in whatever 2021. That will be for accountants to verify. So, and this is very detailed process which will apply to every single line in the prospectus, because it's important from risk management perspective. So lawyers and auditors will be basically interrogating the board to make sure that they can back up every single statement in the prospectus. And that's this a bit tedious exercise, takes a lot of time, it takes a lot of effort. And if you are a corporate lawyer, maybe a junior corporate lawyer, that's what you're going to spend most of your time on potentially if you join like a law firm or will be helping on IPO, is it is due diligence. And if any of the statements are wrong, as we discussed, the directors will be liable, and it's a big potential liability. So directors also take it seriously. So then I wanted to talk about also life of a listed company post IPO, because this is when the life of a listed company starts, basically, because it's just the beginning, right? Effectively, once the company is listed, is now subject to ongoing disclosure requirements, ongoing reporting requirements, which can be quite detailed. For example, the company will be subject to disclosure in respect of insider dealing. So I don't know if you covered this aspect.
It was just an introduction. You started to have an introduction.
Not really. Much later, of course.
Exactly, it's much later.
Okay. Maybe we just touch upon that briefly, but obviously, if someone is in possession of inside information, or in other words, non-public information, which is really material to the company. For example, if I am a lawyer and I'm working on M&A, confidential M&A transaction, and I know that, I don't know, this is in the news, like for example now, Rio Tinto want to buy Glencore business, right? It's a potential public takeover. So, and if I'm a lawyer at Rio Tinto and I know they want to make this acquisition, I may want to, obviously buy the shares, well, let's say, of Glencore and make a profit, because once this deal is going to be announced, potentially the price is going to go up. So these restrictions will apply to publicly listed company, and they will have an obligation to maintain inside the lists, which have access to this public, private sensitive information. And there is also a requirement to report on significant transactions, provide regular financial statements, So yeah, from a kind of cost perspective and from a legal perspective, once the company is listed, there are quite onerous disclosure requirements applicable to the company. And then similarly, there are requirements applicable to the governance of the company. It sort of depends on where the company is listed. If the company in the UK listed on the main market, the governance, corporate governance requirements are stricter than in respect of companies which are listed at alternative market. But in the UK, there is a UK Corporate Governance Code 2024, which listed companies are expected to adhere to, and it deals with, for example, independent non-executive directors being on board, which is an important consideration for I guess, oversight of the work of the executive directors, which is normally not an issue for a limited company, but listed companies need to have independent oversight on its activities. Similarly, as I said, there are requirements in respect of inside information and not breaching requirements in respect of insider trading, and there is a strict liability in respect of breach of insider information and market abuse. I don't know. Do you know of examples of potential like market abuse restrictions apart from insider trading? Like for example, market manipulation techniques when the company is, or not the company, but the investors, for example, pump and dump shares, or they undercut the price. So all of these activities are highly regulated, and there is a liability applicable to any manipulation of the market. And funny enough, back I don't know, before the 30s, it was not a thing, and it may be in some of the emerging markets. People were doing this for years, making money on the stock exchange. I think this is how many of the real estate magnates kind of made the initial money on the stock market, just trading inside information. But obviously these days this is highly restricted, highly regulated. I'm struggling to do any trading in shares because I'm a lawyer and I work for an investment bank, so I'm always involved in numerous transactions. So because of that, if I want to buy or sell any shares, I need to get consent from management. And then when I'm given consent, it's only valid for like 48 hours. So I just give up any share dealing because it's just so impractical. In 2 days, anything can happen in the market. So it's just completely impractical to invest in any shares. So, what I was going to say is another aspect, obviously, is relationship with investors and reputational exposure of the listed company, because it's now in public domain. The investors are watching what is happening with the company. So I guess the company would need to also hire, additional support from investor relationship perspective. All of these sort of aspects are also underpinned by laws and regulations, as I said, by UK market abuse regulation in terms of insider trading, by FCA handbook in terms of the ongoing obligations, and then in terms of corporate governance, there is a UK corporate governance code. I was going to ask like also a practical question because of the ESG aspects. Do you know what ESG is? What is it?
Environmental, social governance are certain standards that companies are required to comply with in order to support the environment.
Mm-hmm. So yeah, in particular, like, environmental aspects are really important for companies these days because I think if you just look at the history of corporates, initially when you think about what is the goal of a company, people only think about adding value to the shareholders. When you think about modern companies, their goals are normally wider, so they have to actually take into account environment, maybe some of the social aspects of the country they're operating in. So ESG is now at the core of the purpose of the company. And if a listed company wants to report on its ESG achievements, it's important to manage this from a kind of a legal perspective, because often it's tempting to make statements which are not kind of backed up by any data, and there are tightened greenwashing risks associated with these kind of statements. So in order to manage these risks, certain steps need to be taken by lawyers within the company. So what do you think would be the steps? What would you recommend on the basis of what we discussed the listed company should do in order to manage potential liability? Any ideas? I mean, there is no wrong answer.
In which regard? Regarding to ESG?
Let's say, well, if they want to publish reports on its growth, however, from the ESG perspective, but it's the metrics on this report are not very certain, and it's worried about how it's going to be perceived by the investors. So what?
I think it's really important to put metrics in your perspectives. Regarding to ESG in particular, since the regulations in ESG are decreasing, for instance, Omnibus, the focus is less on ESG, also in the US is strong, but still there's upcoming ESG activism, so part of shareholders finds ESG more important. So literally, it's more sustainable in both ways for the company to invest in the long term in ESG rather than put it on the side. So I think regarding to the perspectives in ESG, it's really valuable for the long term and for your shareholders and the activists to invest in those figures and publish it, because the regulations don't require it yet. But I think it's still really important for the long run.
Yeah, I mean, I agree with that. Sure.
There are also several downturns on that. The first one is that ESG compliance is very expensive for companies. And the second point is the mismatch, the global mismatch between regulation. We have the Asian market that doesn't build all this legal architecture around ESG. We saw the United States that did a huge step back on ESG compliance. So all that certainty about the future, we lost it. And lastly, are we that sure
Yeah, I mean it's a valid point. So you wanted to add.
The most recent statistics show that despite the developments in the EU and US regarding to the regulations, that still the major of the companies care about ESG despite Trump and the omnibus. And I think it's actually that trap, what you're saying, if you think about the compliance cost, that is short-termism, and that is your trick for the long run. So yes, it is expensive, but it's sustainable in both ways.
Yeah.
In my opinion, to invest.
Yeah, it's thanks for that. I mean, on omnibus, it's really kind of weird what the Europe kind of did, because I think that many companies, there was a survey done, and many companies thought that they would rather continue doing like reporting under the old, more strict requirements, because they already kind of geared up for it. So 60% of companies were happy with continue with more strict ESG regulations rather than their simplification. But then there's also another group of companies which kind of decided to wait and see because of this omnibus requirements, which are meant to make it kind of easier for companies to comply, and also delaying some of the regulations.
You still have the ESG activism.
Yeah, there's still ESG activism is still.
Which is a major problem if you see the voting rights they have.
Yeah.
They make it impossible for Shell, for instance, to navigate and develop if they don't comply with their values.
Yeah, I mean, I completely agree, and I think in the US, indeed, there's a completely different picture than what's going on in European Union, and I think, well, in Europe, one of the problems is uncertainty, because of all of these developments, market, was uncertain, like what is going on? Are we implementing ESG, or are we kind of rolling back? And because of that, it creates instability. Companies cannot prepare for the future because they don't know what the regulatory framework is going to be. So uncertainty is bad for the business. So if we have to speak to you speak to regulators, right? So please tell them to make their mind. Are we kind of doing this, or what's the plan? Because I think uncertainty is not good. And indeed, there's a lots of NGOs are very active, and there are like litigation cases. And I work for HSBC. So when if I want to like publish any article, I need to get like a license for that, because they're really worried that something may be picked up in the news. Similarly, even like for public speaking, I need to get a license, because everyone is worried that NGOs can dig something out and then make a big, a big claim out of some statements I made in public. So big corporates, and particularly like I work for a listed bank, right? So really care and worry about all of this activism. So it's really important to manage this, and for a listed company, that's particularly relevant, right? Because if some news are going to be leaked or picked up by media, then it's going to have negative impact on its shares. So I was going to kind of suggest a couple of things from this perspective. Then obviously, if the company is making any statements publicly about ESG, it needs to get third-party verification, because it can help to prove a statement. Then it's helpful to also consider ESG in the board governance processes. think about what kind of jurisdictions are involved, because ESG regulated differently in various jurisdictions. Also, like in the US, for example, right, as you mentioned, there's a lot of activism, and there are many actions of investors and group actions which are quite risky. You may want, as a lawyer, you need to think about, what kind of jurisdictions are relevant from the investor perspective as a publicly listed company. And then maybe like also review your insurance cover, because you may want to get insurance in respect of potential litigation. So yeah, in short, the life of the listed company, like from the disclosure perspective, is not really easy. It's important to adopt the risk-based approach and try to verify public statements of a listed company, in particular in respect of ESG. So I guess, yeah, I just have a bit of time for key summary, and maybe just I don't know if you have a couple of questions. So I guess in terms of like key takeaways, I would say that IPO and public listing is a major event in the life of the company. It's it's a strategic finance event which is accompanied by very heavy disclosure of the key information about the business, and also key risks for the some of the parties involved, such as the issuer and his board, because the board is liable for the statements in the prospectus, and we lawyers are often involved in managing an allocation of risk in the relevant documents which we discussed, right? So every single party involved will try to avoid the risk and avoid liability. So they will just include disclaimers, limitation on the liability, and we as lawyers often involved in negotiation of these documents to try to protect our client and shift responsibility to someone else. And then prospectus is is discussed, like it's really based from a UK perspective. Prospectus regulations are based on key principles which are quite similar in other jurisdictions. That's why I wanted to touch upon some of the key principles, because they're applicable not just in the in the UK but also in other jurisdictions. And then obviously if you ever get involved in IPO or prospectus issuance, I think diligence and governance really then drive the result. So for the IPO to be successful, you really need to kind of stay on top of your game and support